Hello and welcome to this edition of IPO Review and this interaction exclusively on ICICIdirect. Today, we are being joined by Delivery Management. Delivery is bringing its IPO starting from 11th May and closing on 13th May. Delivery, as you know, over the last few years has grown rapidly in revenues, more than double the revenues, and also again operates basically across all the major 5 categories. The sort of main important point about delivery is that it's operating across most of the pin codes in India. Let's try and decode what is the USP, what has been working. And for that, let's invite the management of the company, Mr. Sandeep Barasia, Executive Director and Chief Business Officer, and Mr. Amit Aggarwal, Chief Financial Officer, Delivery Limited. Gentlemen, welcome to the show. Now, first of all, for our viewers, help us understand what is the USP of the business, what is the business model, and what is working for you?
Great. Thanks so much, Piyush. Thank you for inviting us today. See, the Delivery is a 10-year-old company. Over the last 10 years, we've gone from a starting point of zero to now becoming India's largest and fastest growing supply chain company. We cover, as you said, 17,000 pin codes across the country, everything from Ladakh to Andaman Nicobar Islands to Northeast to Kutch. We're a national player. And as you rightly said, we cover all the large segments of the supply chain industry. There are 5 key segments we operate in: express parcel, which is mostly e-commerce; part truckload, full truckload; supply chain services, where we combine warehousing with transportation; and cross-border. The latter 4 tend to be more B2B, and the first one is more B2C. Now, what works for the company are several things. Number one, we have a unique underlying market. The underlying market is very, very large. It's over $200 billion today, and will go to $300 billion over the next 2 years. This is one of the largest addressable market sizes of any industry that you will find anywhere, especially in a country like India. And especially given the fact that we are a $3 trillion economy going to $5 trillion economy, this market will keep expanding. What's more is that logistics is so quintessential. Everything that you sit on, every pen that you use, the recording that we're doing using the laptops, they've all had logistics behind them because they've had to move. So anything that's manufactured, anything that's traded will get moved. So it's a completely non-discretionary, quintessential part of the economy. That's the first thing that I think that's very important to understand, is that our addressable market is very large, extremely fragmented. We are the largest player in the market, and we have less than 0.5% share of the market. And it's quintessential, right? That's the first thing. Number two, we are the only player that actually does all of these 5 business lines. And we do all of these 5 business lines using a common network, common infrastructure, common technology. That is very hard to do. We also deploy something called a mesh network, which is very different from what rest of the logistics companies do, that tend to be hub and spoke, simple hub and spoke networks. That does not enable them to add all these business lines very easily, achieve the same level of precision that we do, or the same level of unit economics that we are able to achieve. So we are able to bring all of these 5 businesses together, go to a customer, and actually sell them multiple services. Today, we work with over 21,000 customers across all these, and 58% of our revenues comes from customers who use 2 or more of these services. So we're able to cross-sell. For instance, on the e-commerce side, we will work with pretty much everyone. It doesn't matter who's going to win. We work with every single player in the market. So that's the second point, is the fact that we work across all these business lines and the network design that we have. The third is that the entire technology platform for this is written by ourselves. It is completely proprietary. We've written it line by line. The code has been written by us. This is very, very hard to do, and it's not available off the shelf. So that is a unique part of our business model, and it's fed with a lot of data. 1 terabyte of data every single day. Until December last year, we had done 1.2 billion parcels in the country, and we sit on all that data, and that data goes to refine this stuff. So those things are the ones that work for the company. We have a young management team. We've got growth momentum. We've got improving unit economics. We've got a strong balance sheet, which has allowed us to do M&A and acquisitions. So we've got several things going for us as a company, which makes us very, very different.
Well, that is interesting. And I think that will make everybody interested to really explore the term operating leverage, because I actually was observing what you were saying, and then I started thinking, if you're operating across all 5 segments, if there is a single tech platform on which you are loading everything, there is intelligence which is going across all the clients, and you're refining it, using it to really churn up more volumes there. then the question comes is operating leverage, because operating leverage leads to higher profitability, higher numbers, and obviously for the investors in the future, much higher returns actually. So when that kicks in and how that kicks in?
So let me start, and I'll request Amit to jump in. But let me clarify something for your audience. I think the right question for delivery is not the path to profitability. I think the path that is no longer a question for delivery, and I'll explain why. I think the right question is how do we scale up profitability from here, and not path to profitability. Now, over the since to FY19 to FY22, just 9 months of FY22, the business has grown from 1,600 crores to over 5,170 crores. Right? That's more than 3x growth in that period of time. During that period of time, we've also brought down the cost of serving customers. An average parcel yield has gone from 92 rupees to 72 rupees in this period. So we brought down the cost that we charge, price that we charge to customers in that period of time to actually ship an item. Despite doing that, our profit unit economics have improved massively, and our adjusted EBITDA has gone from minus 11.3 in FY19 to almost break even in the 9 months of FY22. Just 9 months of FY22. So you can see where the operating leverage is kicking in, and why I say the question of path to profitability is not the right one. Also, actually, in our DRHP, we had first filed the DRHP with first quarter numbers only of FY22. In that, we had reported that our adjusted EBITDA was minus 3.7. On 9-month basis is almost breaking, which means the combination of second and third quarter would have had to be profitable. And so that's why the question is no longer of whether we are profitable. The question is no longer whether we will achieve profitability. The question now is how do we continue scaling it up from there? And for that, I think Amit is well placed to answer that question. Amit, please go ahead.
Sure. Piyush, Sandeep explained how the unit economics has played out for us over the last 3 years. One important point I want to highlight is the growth of the newer businesses. Express Parcel is our flagship 10-year-old business, but the other businesses such as part truckload, full truckload, supply chain services, and cross-border have really started growing in last 3 to 4 years. Some of these were launched in last 3 to 4 years. The contribution of these businesses in last 3 to 4 years in our revenue was in FY19 was only 300 crore rupees. In 9 months of FY22, contribution of these businesses is almost 2,000 crore rupees. And hence we have been investing in capabilities to scale these businesses faster and profitably. 2 of these areas where we are investing money heavily are technology, data sciences, and business development. In technology alone, our investments are about 240 crore rupees in 9 months of FY22. And in sales and business development, our investments are about 118 crore in the 9 months of FY22. So you can see from the unit economic standpoint, we are profitable. It's the investment we are making to grow these businesses scalable and profitable at that hyper scale is what has caused us to have this slight operating burn or the burn we have had. But Sandeep explained the second and the third quarter can be in the RHP in conjunction with the DRHP to arrive that we are adjusted EBITDA profitable. Absolutely. I just want to take a couple of metrics on operating leverage that we talked about. If you look at revenue per square feet we drive from our business, that has grown from 2,780 rupees per square feet to 4,500 rupees per square feet between FY19 and 9 months of FY22. And our revenue per manpower has also increased from 5.7 lakh rupees in FY19 to 7.4 lakhs in 9 months of FY22. So you can see that we are driving more throughput per square feet. We are driving more volume per person, and we will be driving higher utilization of our trucks, better selection of truck, better route planning of trucks in our network to drive the operating leverage in our business, just like the way we have done over the years in past.
Sure. And even I'm just clarifying when I'm saying operating leverage is definitely one you have highlighted from the perspective of profitability. But I was also asking because you are now present in most of the pin codes in India, and I was thinking how much actually sort of revenue growth we actually could see into like operating leverage implies your existing clients. So how much multiplier effect can we see
Sure.
from those clients? What will
Sure.
be your opinion on that?
Sure, Piyush. I think I'm glad that we clarified and addressed the issues on profitability, because that is something I'm sure is top of mind for everyone as a company goes public. And I think it's important for people to understand the unit economics and profitability of the company. But revenue is always easier to address, especially in a business like ours, where the underlying market is $300 billion in size. You have the largest, fastest growing player as delivery. We did 5,000 crores in the first 9 months. We're sort of on a run rate of doing almost $1 billion in this financial year. But even at $1 billion, we'll be 0.5% of the market, right? Now, our express parcel segment alone is driven by the growth of e-commerce. And that segment by itself is growing at upwards of 30% because e-commerce continues to grow that fast. Part truckload, there's a massive shift from unorganized to unorganized, from slow part truck to express part truck. Supply chain services is all being affected by GST, where companies post GST are starting to rethink what should really be their supply chain footprint, and they're reorganizing it. And so there's all sorts of RFQs that are opening up in supply chain services. And cross-border India is at a very early stage. As India's GDP grows, cross-border trade will grow, and cross-border will continue to grow. And our partnership with FedEx stands us in a very strong position to actually gain that market. So across our segments, underlying growth is there in the segments, and we are gaining share. We are the largest player. We are the fastest growing player in that sector. So we've been growing at 50% per annum so far. And there's no reason to believe, given the headroom in the market and all our competition is so fragmented, they don't have the technology, they don't have the capital, they don't have the network design, they don't have the management team to do this. It'll be shame if you're not able to continue maintaining our growth going forward.
Right. And just one point, as you touched upon, and that was my next question. So let me actually take that on the FedEx. What has changed for you post FedEx coming into the partnership? Yes, it is obvious that international partnership again will give you more opportunities, but broadly, how you see the impact on the business so far?
Sure. I think that's a great question. I think the FedEx partnership, we only got the regulatory approval at the end of November. So we only consumed the transaction in December. So it's only been a quarter. It's too early to see the full impact of what that partnership can bring to us in one quarter. But let me give you the broad highlights of that partnership. First and foremost, it's a partnership for building the cross-border business. So far, without FedEx, a lot of our cross-border focus was just in India-China lane. Whereas India's largest trading partners are North America and Europe. What this partnership has done is opened up the North America and Europe lane for us as well, because FedEx is a global player. So we have access to FedEx's global network. FedEx, before the partnership with Delhivery, did a smaller number of pin codes on their own in India. Now with Delhivery, they have access to the full 17,500 pin codes in India and a high quality service provider. If you combine these two, you actually can really truly offer a differentiated product for cross-border, leveraging Delhivery's strong India network, FedEx's strong global network. That's really the ambition that we're trying to do. Now, there are other benefits though. The number one thing is that if FedEx has also invested $100 million in Delhivery and become a minority shareholder, now that's validation for us from the world's largest express parcel company, that Delhivery actually is the company that they felt was actually something that they want to invest in and be a shareholder of. But along with that, the COO actually joined our board, and they bring huge amount of experience. As we start scaling up this business beyond the 5,000 crores, having that partner with us who can actually share the experience with us will actually make us even stronger. And so the benefits of that are yet to come. And then last but not the least, FedEx operates in many, many emerging markets. We have an ambition to actually start externalizing our technology stack, as you might have heard. And so the FedEx network also allows us to experiment and see how we can start externalizing our technology stack. So many benefits coming out of that partnership.
Right, and that should be something exciting for the investors to really look forward to. Dear viewers, let me also remind the issue size of Delhivery is around 5,225 crores. Around 4,000 crores would be coming as a cash into the balance sheet, and around 1,235 crores again would be as offer for sale from existing investors. Now the question is, 4,000 crores coming into the balance sheet. It definitely sounds like there could be some good plans of expansion or sort of good plans of inorganic growth. So what will be the color on this, the utilization, and perhaps what impact we could see on this?
As Amit was starting to outline, out of the 4,000 crores, 2,000 crores have been set aside for organic investments. This is primarily going to be investments in doubling down the businesses that we have. We want to take advantage of the $300 billion market opportunity. So we're going to deepen and broaden our presence in each of our business segments. So we will make investments around that in terms of infrastructure, technology, and primarily those two areas. 1,000 crores have been kept aside for general administrative purposes, and we're still hiring good talent. We're expanding the business. So we will use those like capital for those purposes. And the remaining 1,000 crores, 25% of it has been kept aside for M&A. Now, we also have 2,900 crores in the balance sheet as of December 21. So the combination of that actually obviously creates enough corpus for us to meet all organic and inorganic needs. M&A is going to be an important component of Delhivery's strategy going forward. I think we've displayed by the acquisition of SpotOn, the FedEx partnership, and a recent investment in Falcon Autotech, we've displayed the fact that we have not just the desire, but also the ability to make these large acquisitions. SpotOn was the largest acquisition in the logistics space for some time. FedEx was one of the largest partnerships on the international, on cross-border in the logistics space for some time. So we are hoping that we will continue doing this. Today, we are the natural consolidator in the market. We look at all deals that actually come in the logistics space, and we'll continue to invest in businesses that are core to our overall strategy. So M&A will be important for us, absolutely.
Right. My last question will be from the perspective of perhaps which investors I think would be thinking why the final IPO size was being reduced. Any bit of clarity? Was it just an acknowledgement to the market conditions? Because we know again what has been happening in the markets, or there was some other plans where the existing investors wanted to divest sometime later. Like what is the thought process?
So I think it's a very good question, Piyush. Two reasons. One, of course, we've advised by our bankers. So they are really the ones advising us on what the issue size should be after taking feedback from us on what proceeds we need to run the business. And that's how we, in a combined way, arrive at that. The secondary offer, which is existing investors selling shares, was reduced by 50% from about 2,400 crores to 1,200 crores. The existing investors, as you rightly said, felt like this is not, they want to stay invested in the business longer. They've seen the prospects of the company and they're excited about it. And so they wanted to reduce the amount that they're selling at this point of time. So that's the number one reason of reducing the secondary offer by 50% by the existing investors. And on the primary side, the fact that we also had the 2,900 crores in our balance sheet as of December 21, the bankers advised, and our feeling was we'll have sufficient cash once we add the 4,000 on top of that to meet all organic and inorganic needs for the foreseeable future. And that's why that was reduced.
Well, thanks a lot, Sandeep and Amit, for coming on the show and helping our viewers understand and decode all the answers. All the best wishes to you for a good IPO. And Delhivery is indeed paving a path in the logistic industry with through technology, through a sort of greater delivery. And we sort of wish you all the well. Thank you for coming on the show.
Thank you so much.
Piyush.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.